In this topic, we understand how expectations of future interest rates determine the shape of the yield curve. Investors constantly form expectations about future short-term interest rates. Even though these expectations involve uncertainty, they strongly influence the term structure of interest rates, which is represented by the yield curve. Depending on what investors expect about future interest rates, the yield curve can take three main shapes: flat, upward sloping, or downward sloping. By examining expected future short-term rates, we can understand why each of these shapes occurs. First, let's look at the flat yield curve. A flat yield curve occurs when investors believe that future interest rates will remain unchanged. In other words, the expected short-term interest rates over the coming years are the same as today's rate. For example, suppose the current one-year interest rate is 6%, and investors expect the one-year rate over the next 3 years to stay at 6%. The price of a one-year zero-coupon bond would be 1 divided by 1.06, which equals 0.9434. Similarly, the price of a 2-year zero-coupon bond equals 0.8900, and price of a 3-year zero-coupon bond would be 0.8396. Since investors expect the same interest rate in the future, they are willing to invest for longer periods at similar rates. As a result, the spot rates across different maturities remain similar, producing a flat yield curve. Next, consider the upward sloping yield curve. An upward sloping yield curve occurs when investors expect future interest rates to increase. In this case, longer-term bonds must offer higher yields to compensate investors for waiting. Suppose the current one-year rate is 6%, but investors expect the one-year rate next year to be 8%, and the one-year rate in 2 years to be 10%. The 2-year spot rate, R2, must satisfy the following relationship. Price of a 2-year zero-coupon bond equals 1 divided by 1.06 times 1.08, which is equal to 1 divided by 1 plus R2 squared. Solving this gives 6.98%. Now we calculate the 3-year spot rate. The price of a 3-year zero-coupon bond equals 1 divided by 1.06 times 1.08 times 1.10, which equals 7.99%. Since the longer maturity rates are higher than short-term rates, the yield curve becomes upward sloping. Now let's examine the downward sloping yield curve. A downward sloping or inverted yield curve occurs when investors expect future interest rates to decline. In this case, longer-term yields become lower than short-term yields. Suppose the current one-year interest rate is 6%, but investors expect the one-year rate next year to be 5%, and the one-year rate in 2 years to be 4%. The 2-year spot rate can be calculated as R2 equals the square root of 1.06 times 1.05 minus 1. This equals the square root of 1.113 minus 1, giving 5.46%. Similarly, the 3-year spot rate is approximately 5.00%. Because long-term rates are lower than short-term rates, the yield curve becomes downward sloping. Finally, it is important to understand the relationship between expected future rates and spot rates. Expected future short-term interest rates determine multi-year spot rates. Here, R1 represents the current one-year spot rate, F2 represents the expected one-year rate next year, and F3 represents the expected one-year rate 2 years from now. This shows that spot rates for longer maturities are essentially determined by expectations of future short-term interest rates. To summarize, future interest rate expectations play a key role in shaping the yield curve. If investors expect rates to rise, the yield curve becomes upward sloping. If investors expect rates to fall, the yield curve becomes downward sloping. If investors expect stable rates, the yield curve becomes flat. However, for very long maturities, expectations become more uncertain, and factors like long-term inflation and real interest rates also influence the term structure.